Robert?
Good morning. I'd like to call the Pension Committee meeting to order. And at this time, I'd like to turn the meeting over to our Alesco advisors.
Good morning, Tim and Jim.
Good morning. Hope everyone's doing well this morning. Before I start off, we just want to make sure we have enough, how much time we have based on your agenda. Just if you give me a quick indication of that.
You got around 25 minutes?
That's absolutely perfect. Thank you for letting us know that. Hope everyone's doing well this morning. Jim and I are very happy to be here to give you an update on the pension. I'm going to pull up my screen right now. Let's see. Is everyone able to see that?
No. Nope. We see you.
Let me come back just a minute. Let me go share my screen. There we go. Okay.
No. Nope.
Now we go.
There you go. Okay.
You're not able to see that?
No,
Yep, that's good.
Okay. Seems like there's a little delay there. Sorry about that.
We also have the handout.
Okay.
Yes.
And yeah, you do have handouts.
That's right.
The big theme that dominated the market trends this first quarter was a change in leadership, both in Washington and in the stock market. There was a greater than expected stimulus coming from the government, combined with very significant progress on the COVID-19 vaccine rollout, in combination with the continued accommodative policy from the Federal Reserve, really set the stage for growth, both coming through in the quarter, as well as expectations that will be the case throughout the year. This continued, this idea that economic growth is going to be stronger, combined with rising levels of employment, the employment picture improving, continued to trend within the stock market itself, where small cap stocks and more economically sensitive and value stocks were the best performing asset classes, while large cap stocks and growth stocks continued to fade from their leadership levels that we've seen over the last couple of years. Combination with that, the strong pace of economic growth and rising inflation expectations also pushed bond yields much higher in the quarter. This hurt the performance of fixed income investments, but it did contribute to some significant improvements in the funded status of pension plans overall. Now, the allocation that Alesco has set for the Centro plans, it was very beneficial based on the trends that we saw here. And the plans that you'll see when we get to the numbers posted some very attractive returns in the quarter. So if we look here on page 1, taking a look at the allocation for the non-salaried plan, you'll see the equity is at 65%, fixed income is at 26.2%, real return assets at 7.1% with 1.5% cash. All within the ranges set by the investment policy. Pretty much where we've had them since we were able to increase the equity allocation last year. Moving on to the next page, take a look at the equity holdings. You'll see about 50% in the large cap space, 4% in large cap value, and the rest push down the capitalization spectrum, mid cap, small cap, and micro cap. Those are the asset classes that performed so well in the quarter. So as you see, roughly 50% of the portfolio is outside of that large cap space. The dominant holding is large cap, but that diversification from down into mid cap, small cap, and also international, very helpful in the performance that we'll see coming up. There's been no changes in the allocation. We've been very consistent with that in the quarter. Taking a look at fixed income holdings, primarily in the broad bond market, but we have continued to hold that shortened duration. And that was helpful from a performance standpoint when the yields started to increase so significantly within the quarter. So taking just a little bit less risk than the overall broad bond market, and that is accomplished through this corporate investment grade floating rate position. So you'll see in the performance that shortened duration was helpful. Any questions about the asset allocation before I move on to performance? Okay. Taking a look again at the performance of the non-salaried plan, we have 3 time periods we're looking at. The first quarter, the full year going back to March of 2020, and then the inception, which was the beginning of the year in 2020. The portfolio ended the quarter at $38 million with a gain of $1.5 million, 4.3% return. And even in the month of April, we've added on a little bit more into performance, about not quite 3% gain. So you're sitting at about a 7% return for the calendar year of 2020. The recovery period is really what we're looking at here for the one-year period from the beginning of the market advance after the coronavirus downturn. Gain of $10.3 million and 37, almost 38% return during that period. Going back to inception, 16% gain since the beginning of 2020 and a $6.3 million gain during that period. If we take a look at page 5, this will cover the performance of the various asset classes within the pension plan, equities, fixed income, and real return. Looking at the column on the left-hand side, first quarter, you can see this trend of performance related to the various asset classes. 18% return in the quarter from small cap stocks, that's the S&P 600. A little bit less, 13.4% for the S&P 400 mid-cap stocks, as compared to the S&P 500, which is 6.1. So the strength of the economy, improving vaccination rates, and higher employment levels all benefit the more smaller capitalization and the cyclically oriented stocks within the value space, which you see here, also outperforming the broad S&P 500 at 10.7%. Those trends played out in the full year period. Looking at the economic, the returns on the equities, 61.35% for the equity market, led by a 95% return in the S&P 600 small cap stocks, 83% for the S&P 400. So you can see that trend really played out for the full count, not a calendar year, but the full year period, looking back to March of 2020. And even since the beginning of the period, the strength of the small cap and mid cap stocks has played through, with the S&P 600 up 24.67% compared to a return of 20% for the S&P 500. International, emerging markets had a very strong period in the fourth quarter, but they still do trail just a little bit compared to the S&P 500 and the domestic sector. So that's a trend that we will be keeping an eye on. But the valuation levels of international stocks are more attractive, and they're slightly behind the U.S. in terms of the vaccine rollout and the economic growth. So it makes sense that that would be the case over the past year. When we look at fixed income, you'll see that impact from rising yields with a decline of 3.29% in the equity, the fixed income holdings compared to the Barclays aggregate. You see that little bit of a benefit in the performance. The aggregate was down 3.37. The shortened duration helped from a performance standpoint just slightly, with the fixed income holdings in the quarter down 3.29%. Slight gain over the past year, just under 1% for the fixed income holdings compared to the Barclays aggregate at 0.71%. And then going back to the inception, fairly close to the benchmark, 2.26% versus 3.11 for the Barclays aggregate. At the beginning period of the our relationship with Centro, we did see a pretty significant drop in interest rates at the beginning of the pandemic, but that obviously you see is starting to reverse itself as yields are moving higher. The last thing I'll highlight here in terms of the holdings and the real return asset performance is just to notice that the real return assets, which is consisting just of inflation-protected securities, perform better than the broad bond market with a decline of just about 0.5%. That's a sign that the capital markets are starting to think about higher levels of inflation, and the inflation-protected securities perform very well in a rising inflationary environment, especially with some unexpected inflation. So you can think of it as a very nice insurance policy within the pension plan, and it's performing as we would expect it to in the quarter. Any questions at all about the performance of the non-salary plan?
On the fixed income part, you said you reduced the duration. On average, what is the duration of the fixed income portfolio, and what is the current return that the fixed income portfolio is producing?
When you say current return, do you mean the current yield?
Yeah, the income of the bond portfolio
Yeah.
divided by the price.
In terms of the, looking at the duration of the portfolio for fixed income, it's around 6 years, and the aggregate bond market is about 6.7 years. And if you have in front of you the yield on the yield on the fixed income holdings,
The yield's gonna be about 1.4%.
Thank you.
Yeah, the other thing I wanted to add to Tim's comments is just pointing out that both on the prior page and this page, that the far right-hand column represents annualized numbers. So that 16% return that was generated, that's the annualized return. So that would be for, in effect, 1.25 years, you're averaging a little over 16%. So it's certainly off to a good start here.
Okay. All right. Any more questions? Run through these couple pages. This is the holdings of the salary plan, and now back to the non-salary. Now taking a look at the allocation for the salary plan. Similar allocation here to the previous plan. I'm not going to spend a lot of time going through each holding here in terms of the mix, 65% equity and everything else in line with the investment policy. We look at the equity holdings similarly allocated in the plan, with the large cap being the largest holding. International at 30%. Have the shortened duration here in the bond portfolio as well, 10% allocated to the corporate investment floating rate bonds. Performance, identical due to the asset allocation being similar in both plans, 4.3%, 37.5% in the 1 year, and then annualized returns again at 16%. You'll see the same trends here in the holdings with equities, fixed income, and real return assets. Through the holdings for the plan, so we'll get to Utica. And again, same allocation, 65% equity, fixed income at 25.7. This is the smallest of the plans, but allocated in the same manner. Equity allocation the same, 70% domestic, 30% international, with material holdings in the other sub-equity asset classes. Fixed income, again, at 90% broad bond market, and then the 10% corporate investment grade floating rate. And you'll see performance the same as well, 4.3%, 37.3%, and 15.9% for the Utica plan. Value at 10.57 at the end of the period, and a gain in the quarter of just about $434,000. Same with the underlying asset classes, equities, fixed income, and real return, same trends, small cap outperforming large cap, and value outperforming growth. Any questions related to those before we move on? No other questions, then I'll hand it off to Jim, and he will take us through and spend the next few minutes going over the capital markets review.
Yep. Thank you, Tim. I just want to circle back with this group and remind you that when we first started working for you, we did some modeling work, and it suggested that you increase the equity allocation back early in 2020, which you did, and the timing of that turned out to be very, very good. Pretty much at the bottom of the market, we put more money into stocks, and that worked out very well for you. So it may have been a difficult decision for you to make, but it was not only the right long-term decision. Fortunately, it turned out to be the right short-term decision as well. So congratulations on that. Tim, if you could go to the capital markets review. Thank you. Yeah, just go to the next slide, if you would, please. Thank you. So as we talked the last quarter, the big issue right now for the capital markets is trying to get a handle on the race between COVID-19 infections and immunizations. And as you know, depending on where you're looking on the planet, there have been different levels of success. The United States is really doing, I believe, a remarkable job in rolling out the vaccine. We're at a point right now in just about every part of the country where anybody who wants to get a vaccine who's 16 years or older can get one. And so the big push right now is getting people to be comfortable with the concept of getting vaccinated and recognizing the impact it has for the greater good. The rest of the world, there are many parts that are not anywhere near as far along in this effort as the United States. And that is really where I think the investor mindset is focused at this point, recognizing that if we have pockets of where there's significant levels of higher infection, that increases the likelihood of just by there being more time, the passage of time, of mutations occurring in the virus, and then there being and then perhaps rendering the to-date immunization effort less effective. And so that's what the scientists are tracking. That's what government leaders are working against. Don't be surprised if we see a concerted effort by the Western world to truly try to ramp up immunization efforts outside of the Western world as we get later into this year. Next slide, please, Tim. So the impact of this, of course, is all, from an investment standpoint, is all, the question is how rapidly are things going to open up? How rapidly the economy going to recover? And in the United States, it's a very positive story. I'll just take a quick peek at the top of this slide, and just if you haven't looked at the construct of gross domestic product in a while, it's perhaps of interest to you. So GDP, an acronym that gets widely used, may not be widely understood. GDP, of course, stands for gross domestic product, but it really is more than 2/3 of it is what you and I spend. It's personal consumption. That's the big driver. And that's why Alesco and most other people in this industry spend a lot of time tracking consumer behavior. And so we're going to talk a little bit about that today. About a little less than 20% is government spending. And it's important to note, second bullet on page 24, what government spending includes. And probably more importantly, what it doesn't include. It doesn't include transfer payments, subsidies, and interest expense. So those numbers are picked up in consumption, ultimately. And then business investment as well. And then there's an adjustment as to whether or not we are importing goods or exporting goods. If we're net exporters, that would be a blue bar. When we're net importers, the economists refer to that as negative net exports, which is kind of a crazy way of thinking about it, but that's really net imports of about 3%. And that's what makes up GDP. Okay, so where are we going with this? Where's the U.S. GDP projected to be? Well, the Federal Reserve, as well as numerous private sector economists, are predicting robust growth for 2021 to the tune of 6.5%, which, if indeed that were accomplished, it would be the highest level of economic expansion since 1984. Admittedly, a large part of this is recovering ground that was lost over the past year, but we are looking at, you'll see in a minute, we'll be really reaching new heights as it relates to aggregate economic activity. In addition, for 2022, the expectation is for us to have pretty attractive levels of economic expansion as well. And it could go beyond that. You may have heard different business leaders. Jamie Dimon, as an example, got a lot of traction with his announcement. He thinks that we're going to have above average levels of economic expansion for several years to come. Next slide, please, Tim. So we talk about the consumer. This is data. If you haven't seen it, it may be a bit surprised. Personal income data, we're back above where we were before the pandemic started. This is in large part due to the stimulus payments that went out, which is treated as income for purposes of this discussion. Accordingly, the savings rate has also improved. You'll see the personal savings rate at the bottom of this slide, the bottom chart, has jumped up a lot. And it's estimated that 30% or more of the stimulus payments that have gone out have been used to either reduce debt or to be or put in savings. Both of those will lead to future economic activity. If people pay down their credit card, that gives them the ability to put more on their credit card later on. If they're putting money in the bank, in their savings account or their checking account, in their investment account, that gives them the opportunity to spend in the future as well. So this is very positive news as it relates to future economic activity. Next slide. Just a couple of other data points. The top chart here looks at items that are indicative of consumer mindset, consumer confidence. We're looking at seated dining, TSA traveler checks, and traffic, and then driving directions. And you can see, while the driving directions recovered very quickly back in early on in the pandemic, the seated dining and traveler activity was quite low. But you can see at the right-hand part, things are moving up quite significant. Household spending at the bottom of this slide is back up to where we were before the pandemic. Again, this is a large part of this is attributable to the stimulus checks. However, it's how people are spending money which is different. That people aren't necessarily going to the movie theater. They may not be going out to a restaurant, but they are spending money, and they are spending money. When we talk about restaurants and dining, there is a lot of spending going on in that part of our economy, but not all of it seated dining. That is an area that's still very much depressed for all the reasons you're aware of. Next slide. Just a little bit about employment. You may have seen the initial job claim numbers yesterday. They were the lowest they've been since the pandemic started to occur. Great jobs number in March. You can see the top left bullet here, 960,000 jobs created, 30% of which, over 30%, was in the leisure and hospitality industry, the hardest hit sector of the economy. You'll also see that the top chart on this page, it may be a little tricky to read, but the black dot represents where, based on levels of education, the levels of unemployment. And so, perhaps not surprisingly, the higher level of education, the less likely those people were to be unemployed. What you'll see also, if you look at the yellow bar, which would be just 1 month after the March black dot, where unemployment took place. That's where we had the 20 million in layoffs, and again, it impacted people who had lower levels of education, but not because they had lower levels of education. It impacted them because of the sectors in which they work, mostly the leisure and hospitality and entertainment sectors. So it's important to understand the cause versus the effect here. We think one of the more positive data points is the lowest chart here is people who are unable to work. We have a picture of you there in the boardroom. You're showing up, you're meeting together. This organization has done that quite consistently. A lot of people haven't, but a lot of people are starting to do that. We're seeing more and more in-person meetings. Our firm is doing more and more in-person meetings, and I know that's very anecdotal, but those are trends that are occurring across the country, and that is very important for people to do more of that so that they have the confidence that they can meet in person without contracting the virus. I'm going to pause for just a minute to see if there are any questions.
Yeah, Jim, what effect, these are surprising numbers when you look at the outlooks, the high GDP, the low unemployment, strong dollar. Where do you think is gonna happen when we actually have to start repaying all this money we're spending? I mean, what are they, we're at what, $7 trillion now? Somebody's gonna have to pay that back at some point.
Yeah, that is the, I think in the old days they called it the $64,000 question. I think we got to call it now. That's the $6 trillion question, right?
Exactly.
Tim, could you go forward to the next slide? Go ahead, another one. Okay, so this is really this is what we're getting at. If you look at the top right-hand part of this, where we look at the stimulus comparison data. And you look at we did a $840 billion stimulus package during the Great Recession versus $5.6 trillion, which has been done to date, and another potentially $3 trillion in an infrastructure bill. Those numbers are staggering, and as you're suggested, how do we handle this? The answer is nobody knows for sure, and what we hope happens is that we have what's called a high multiplier effect, and the multiplier effect is what macroeconomists refer to when you take $1 of governmental spending and what do you get more than $1's worth of benefit as it relates to economic activity. So let's talk about this stimulus package. Somebody gets a check for $1,400, and they go out and they take that $1,400 and they put a new deck on in the back of their house, as an example. I'm making this up. So they spend it. Well, that $1,400 is then transferred as income to the construction company who rebuilt the deck on the back of that person's home. And then the person, that construction company who receives that $1,400, that goes into their payroll. Those people go out and they, the employees of the construction company, they may use their income to buy a new car, and that car, that income goes to the automobile manufacturer, and so on. You get the picture. So the question is, how big of a multiplier do we have on the stimulus spending? If the multiplier effect is large, if it's like 2.5 to 3 or something like that, would be very stimulative and would have such a big impact on economic activity that the debt impact is mitigated because of the economy has grown to be so much larger that you have tax revenues will expand and to offset that. If the multiplier effect is low, then that favorable outcome does not occur, and now we have all this debt that has to be repaid. And then we really have a problem, and it's very likely to be extraordinarily inflationary. And I don't ask me to put a number on that, but I'm not talking about 2.5% levels of inflation. I mean numbers that could be considerably higher than that. And so that's the real gamble that's being taken right now, is whether or not this stimulus spending has a meaningfully favorable impact on future economic activity. And we won't know that until time passes.
And then you also mentioned, how the large caps are pulling back a little bit, small caps are generating the returns. And then, from an asset class standpoint, where do you see from a sector standpoint being the most robust?
Yeah, Tim, could you go forward a couple slides here? Go to the rotation slide. So the answer is nobody knows, and we don't know. But there's clearly if we have a 6.5% GDP growth, which the Federal Reserve is stating, and as I mentioned, many private sector economists believe that those are reasonable numbers. the cyclical parts of our economy are going to be the greatest beneficiaries. And so if you look at the blue bars here at the bottom of this chart, that shows what's happened in the last 6 months. The 6 months ended March 31st, the fourth quarter of 2020 and the first quarter of this year. If you look at the left-hand part of the slide, you see that value has done considerably better than growth if you compare those two blue bars. And then the right-hand part of the slide, those first three sectors, consumer discretionary, information technology, and communication services, those are traditionally growth-oriented sectors of the economy. And they do best when interest rates are low because the investors are discounting earnings that are many years into the future. The more cyclical businesses, industrials, financials, energy are the three noted here, have done exceedingly well over the last 6 months. Those are areas that if the economy does expand, particularly in the neighborhood of the 6.5% range that that's being projected, those are areas that are very likely to continue to do well because their operating leverage is such that when they get higher levels of revenues, a large part of those revenues can drop to the bottom line. So the corporate profitability will increase in a very dramatic fashion with higher levels of economic expansion. Does that answer your question?
Yeah, that was good, thanks.
Okay, we just want to keep things moving here because we're on a schedule.
Sure.
It's been a very good presentation. Is there any other thing that you really need to mention at this point before we move on?
I just wanted to just a brief comment about interest rates. The Federal Reserve, there's an old saying, and in the investment world, don't fight the Fed. The Fed is indicating that they are going to keep short-term interest rates lower for an extended period of time. Jay Powell said last week that most board governors felt that they would not be looking at changing Fed funds rates until at least 2024. I personally find that hard to believe, but that's what they're saying. And that the Fed also has been very active in their open market transactions, meaning buying bonds in the bond market to the tune of $120 billion a month, both treasuries and mortgage-backed securities, and that's keeping intermediate and longer-term rates lower as well. So the lower interest rates, the stimulus spending that's taking place, consumers having a positive mindset and being willing to spend, being ready to spend, this all suggests that the economy is going to do well. What none of us know is whether or not the stock market's going to continue to do well, because the stock market may be a little ahead of itself with the run-up that we had. It may not. It all depends on how dramatically corporate earnings expand from here. So that's it. Thank you all very much. Are there any more questions? I'm not going to end the meeting. I'll let you do that. But if there are any more questions, be happy to try to answer.
Thank you. It was a very, very good report. I enjoyed it, actually. Thank you.
Yeah, thank you for
Thank
your
you.
presentation. And,
Thank you. Have a good day.
Okay.
and that concludes the pension committee meeting.
Okay, Robert, thank you. Okay, at this time, I'm going to ask for an executive session, a motion to discuss pending litigation and performance of a specific person. Any motion? Robert, second. Joe, all in favor? Aye.
Kathleen? Aye.
So Darlene and Tina, if you could log off and join us on the other number now.